Today, we're going to pull back the curtain on a topic that literally powers every single business you know and love: corporate finance. You can think of it as the playbook for how companies create, manage, and grow their value over time. So let's just dive right in.
You know, it really all boils down to this one question. It doesn't matter if it's your local coffee shop, a family-run business, or some giant tech company, they are all trying to crack the exact same code. How do you take what you have today and turn it into something way more valuable tomorrow?
And here's the secret. It is not an accident. It's not luck, and it's definitely not magic. Real, sustainable success is built on a framework, a way of thinking that helps you make smart, strategic decisions. And that framework? That's corporate finance. We're going to break it all down for you.
All right, so let's start at the very beginning. What in the world is corporate finance? Well, if you remember one thing, remember this. It's all about looking forward. It's all about the future.
To put it simply, corporate finance is basically the art and science of making decisions that will shape a company's future. It's so much more than just managing money. It's about actively using that money to build a stronger, more valuable company for tomorrow, for next year, and for the decades to come. Now this is such a critical distinction because so many people get them mixed up. Think of it like this. Accounting is like a historian. It looks backward and perfectly records everything that already happened. It answers the question, so what happened? But finance is the strategist. It takes that history and asks the much more interesting question, okay, so what should we do next?
So, to make all those big future decisions, you first need a map of where you're standing right now. And in the world of finance, that map has a name: the balance sheet. Now, I know the name balance sheet might sound a little intimidating or boring, but I promise you the idea is incredibly simple. It's just a snapshot, a single picture taken at one moment in time that shows you two very simple things. On one side, all the stuff a company owns, and on the other side, exactly how it paid for all that stuff. That's it. And here's that map laid out perfectly. On the left, you've got your assets. These are all the things the company uses to make money. On the right, you have the only two ways a company can possibly pay for those assets. It can either borrow money, that's called liabilities or debt, or it can use money from its owners, which we call equity. And the golden rule is those two sides always have to balance. So let's zoom in on that left side for a second. Assets are broken into two main buckets. You've got current assets. That's the short-term stuff you need just to keep the lights on, like your cash and your inventory. And then you have fixed assets. These are the big, long-term investments that are the engine of the business, like your buildings, your machines, or maybe even a really valuable patent. Okay, now let's hop over to the right side, how you pay for everything. Liabilities are pretty straightforward. It's debt. It's money you borrow that you have to pay back. Shareholders' equity, on the other hand, is the owner's stake in the company. It's their skin in the game. It's what would be left over for them if the company sold off everything it owned and paid back every penny it owed. Okay, so now we have our map, the balance sheet. So how do we actually use it to build value? Well, all of corporate finance really just boils down to making three key decisions over and over and over again. These three decisions are the engine that drives everything. And here they are, the big three. Number one, what do you invest in? Number two, how are you going to pay for it? And number three, how do you manage the day-to-day grind to make it all work? Let's look at each one. So first up, and you could argue this is the most important one, is the investment decision. This is the big picture stuff. For our little coffee shop, this isn't about deciding which coffee beans to buy. This is asking, should we drop $10,000 on a brand new top-of-the-line espresso machine that will help us serve customers faster and make more money for years to come? So, once you decide you do want that new machine, you immediately face the next question. How are you going to pay for it? That's the financing decision. So, for the coffee shop, do they go to the bank and get a small business loan? That's debt. Or does the owner just put more of their own savings into the business? That's equity. It's a really critical balancing act. And finally, the third decision, the operating decision. This is all about managing the short-term, day-to-day stuff. I mean, it's great you have this amazing new espresso machine, but do you have enough cash in the bank to pay your baristas this Friday? Can you afford to buy enough milk for the morning rush tomorrow? You'd be shocked how many big companies go under because they mess this part up. So we have these three decisions: investing, financing, operating, but what's the point of it all? What's the North Star that guides every single choice? What's the ultimate goal? Well, it's actually a little more sophisticated than just making a profit. Here it is. The primary goal is to maximize the value of the firm.
which, for a public company, means making its stock price as high as possible. And notice, it's not about the biggest profit this month. It's about making a whole series of smart choices that convince the world this company is going to be incredibly valuable for a very, very long time.
And to really understand value, you have to understand why finance is obsessed with one thing: cash flow. See, accounting profit can kind of fool you. You can have $1 million in profit on a spreadsheet, but if your customers haven't paid you yet, you don't have $1 million. Cash flow is reality. It's the actual money coming in and going out of your bank account. That's what creates real value.
And you know, the real beauty of having this one single goal, maximize the firm's value, is that it gets everybody on the same page. The CEO, the manager on the factory floor, the investors, they're all rowing in the same direction. Every decision can be judged by one simple question: will this make our company more valuable in the long run?
All right, so I get it. This might all sound a little corporate and abstract. You might be thinking, what does any of this have to do with me? Well, it turns out understanding these ideas can have a huge impact on your own life.
Seriously, this isn't just for Wall Street types. If you ever want to run your own business, this is your toolkit. If you invest your own money, this helps you see which companies are truly healthy. It just helps you understand the world better, to see past the headlines and really get how value is created.
So I'll leave you with a challenge. The next time you see a news story about a company making a huge acquisition or launching a new product, try not to just ask the accountant's question, what happened? Instead, ask the finance question, what big investment or financing decision did they just make, and how do they think that's going to make the company more valuable? When you start thinking that way, you're thinking like a strategist,